credit card debt is definitely becoming a major problem and is a leading indicator for a slowing economy. Look at this chart for the recent credit card delinquencies. There is no doubt that it is not only going up, but going up quicker than we have ever seen.
Stock prices, and they have other cushions and are less impacted by this rise in inflation. So there are different segmentations of the consumer, and all is not well with that lower end. There's one consistent theme that I heard when retailers reported last quarter earnings, which I expect to hear in the coming weeks. It's that consumers are prioritizing spending on non-discretionary items. And even Walmart said more people are shopping at our stores that are making more than $100,000. McDonald's the other week, when they reported earnings, I think last week, said more people are shopping at our restaurants that are making more than $100,000. So the consumer overall is prioritizing their spend.
How do they know that? When I go to one of these places, they don't ask me, what's your income?
It is a great question. I think they do have some surveys that they then sort of extrapolate from. So yeah, when you go and you pay cash or you pay your credit card, they're not immediately going to know. But I think there are some surveys that are done that can give them an idea of the type of demography of their customer base.
Got it.
And Ted, I like your point that it really all comes back to the labor market. So we all can kind of keep this delicate dance. It reminds me of what they used to say, you can dance while the music's playing. When the music stops, and that being the labor market, all of this could look very, very different, obviously.
Yeah, I mean, historically, the charge-off rate on credit cards has more or less matched the unemployment rate. And we've been in this period of artificially low unemployment, artificially low delinquencies and charge-offs. Unfortunately, there's only one way to go from here, which is up. The question is, how much does it go up? So far, this normalization has been fairly muted and much more restrained compared to the past couple of recessions.
That's a great point.
Peter, what is your reaction when you hear quite a few of the big Wall Street banks sort of calling off their recession predictions?
I think it's way too premature. I think that the adjustment to this higher rate environment is something that is not clocked in months, not even quarters. It's going to take years, assuming the Fed keeps interest rates higher for longer. Because not everybody's debt resets all at once. It takes time. And I think we have a lot of low-cost debt that has major repricing ahead of us. And that will sort of chip away at economic activity as time progresses, and we further transition to a higher rate environment in terms of the cost of debt that we have as an economy.
I see Ted nodding here. I'm with you on that, Peter, and particularly in commercial real estate, where a lot of debt may roll over next year, and who knows about the ability to refinance at today's rates compared with rates from 5 years ago. Peter Bookvar, thank you very much. Ted Rossman, thank you. Good to see you.
Personally, I think the recession will be clear once student loan payments start and as consumer savings become depleted sometime in October. What do you guys think?